Thank you very much. Good morning, everybody in Hong Kong, and welcome to this panel discussion on LIBOR reform amidst COVID-19. What are the next steps and how do we get prepared? I'm your moderator for this morning. My name is Navin Desor. I'm the Regional Head of Legal for Global Markets at HSBC in Hong Kong. Joining me today, I have four panelists. To introduce them, John Ho is the Head of Legal for Financial Markets at Standard Chartered Bank. Virginie Duval, who's the Head of Legal for Asia Pacific in the Regulatory Advisory Team at BNP Paribas. Ross Allen, who's the Managing Director for Data Strategy at IHS Markit. And then finally, Tri Nguyen, who's a Market Specialist Lead at Calypso. So firstly, I'd like to welcome our panelists today and thank them for joining us on this session. To start with, let me go over to you, John, with the first question. So we're currently in the midst of a pandemic with COVID-19, but we also have the FCA having said that LIBOR needs to cease by the end of 2021. So how's the timing of LIBOR cessation likely to play out during the COVID-19 crisis?
Yeah, thanks, Naveen. I think the key takeaways in terms of the LIBOR cessation timing is that you have an interim milestone and then have your end date. The UK regulators, in addition to international regulators that are working on the phase out of LIBOR or other IBORs, it's very clear that the end of 2021 phased out of LIBOR or other IBORs remain unchanged. That is intact. But as you have alluded to, the pandemic caused by the COVID-19 has caused challenges to market participants, both the buy side and sell side, to sort of focus their resources on the LIBOR transition. And as a result of that, just by way of example, both in the UK, both the FCA and the Bank of England have recognized the challenges that COVID has created for market participants. And what they have done, just by way of example, is to amend the interim milestones. For example, they've extended by 6 months for lenders to stop or cease offering non-LIBOR linked cash products to UK consumers. And the timeline has shifted largely in the context of the cash products to allow sterling-based LIBOR products to expire and to cease the issuance of sterling reference loan products by the end of Q1 2021 as opposed to Q3 this year. So there's a bit of an extension to allow the market participants to comply with the LIBOR transition. But I think a couple of key dates here in the context of OTC non-clearable derivatives. About 2 weeks ago, ISDA have published and launched the dates and the regarding IBOR fallback supplements and IBOR fallback protocols. And key timelines to focus on for audience here is the fact that we're now in the period of what we call adherence to the protocol in escrow. Just by way of example, the protocol covers legacy transactions, and the supplement looks after new transactions moving forward, incorporating the new fallbacks. So between now and the 23rd of October is what we call the date where parties have to adhere in escrow, and then effectively the supplement amendments made by the protocol will take effect on January 25th. 2021. That would be deemed the effective date for which parties that adhere to the protocol will have their legacy book amended. So just in a nutshell, on the effective date, which is the 25th of January 2021, all new derivative contracts that incorporate the 2006 ISDA definitions and reference the covered IBOR will contain the new fallbacks. And then new derivative contracts existing as of that date will incorporate the fallbacks if both parties adhere to it. So obviously now the protocol remains open for adherence, and we would encourage market participants to seriously consider signing up to the protocol and adhere to it, because it provides for multilateral amendments. So in terms of the cash product, there is no sort of hard timeline, but if you look at the ARC bodies in other relevant bodies, in government bodies, they've encouraged the market participants to start looking at the contractual agreement and the exposure and plan for transition as soon as possible. Naveen, over to you.
Yeah, thank you very much. I think the key takeaway there is that the end of 2021 deadline has not gone away, but some of the interim milestones may have moved and pushed out to provide a little bit more time in the pandemic. So I think I'll go over to Virginie, John, and
Hi. Hello, can you hear me?
yes, we can. Thank you.
Okay. Okay, so I think I didn't share. Unfortunately, I lost Naveen, but I assume I'm expected to speak now. So I'll take the floor for a couple of minutes and maybe explain the challenges that are faced by the industry in respect of the LIBOR transition. I think those challenges are very diversified. They are quite easy to identify, and we look at a few of them, but they are less easy to tackle. So why is it challenging, and why we are talking about these topics over and over? I mean, first of all, because of the diversity of products that are impacted by the LIBOR transition. LIBOR rate is present in numerous contracts, in retail mortgages, in corporate loans, syndicated loans, in facility letters, in derivatives, whether they are vanilla derivatives or exotic derivatives, in securities. Again, simple securities, but also very complex structure will reference in one way or another a LIBOR rate or a rate that is linked to LIBOR. So, as of today, not many undertakings will be protected from the LIBOR transition. Most companies, whether banks, insurance, or corporates, have some exposure to LIBOR. So it's a huge project for the industry. In terms of rates, again, it's very broad. It's not only USD. We talk a lot about USD LIBOR because in APAC it's very relevant, but it's also relevant for euro, for yen, for the Swiss franc. And in APAC, we also have a number of local rates that are directly linked to LIBOR because in their methodology, they integrate the USD LIBOR. So we're thinking in particular of MY4 in India. We have the Philippine rate. We have SOR in Singapore, which is impacted as well as Thai baht fix. So when we think about that, obviously it's the dimension of the project and the challenges is huge. In terms of solutions, there are some solutions on the table, but again, they are very diversified. They are not always consistent, depending on product. John mentioned the ISDA protocol, which is being published, so that will be relevant for derivatives. So there is an industry solution which is being offered for derivatives, and I think that is very welcome by the industry. And the protocol will avoid a number of bilateral negotiations. Having said that, it doesn't mean that it's going to be easy on the derivative side. There will be a number of products that market participants will not want to transition under the proposed fallbacks from ISDA, and also ISDA protocol is not covering all the agreements that the industry is using to document derivatives. So that will involve also some number of bilateral negotiation between counterparties. And that is on the derivative side, but we also have on the loan side where the industry is trying to propose some solution. But we have several industry associations. We have the LMA, LSTA, APLMA. We already know that for USD LIBOR, for example, the solution that is being proposed by LMA and the solution proposed by LSTA are not similar because they don't have the same guidance from their regulators. So that's another challenge that the industry will face. And when we consider both derivatives and cash, we are automatically thinking of what about a mismatch when you have a derivative hedging a cash product. So that's going to be another question that market participants will have to answer. And this will involve bilateral discussion, obviously. And what will be the solution? I don't think anyone has the perfect solution today. We can imagine a situation where the buy side will want the derivative to match with this cash product, but that creates a basis risk for a bank. So that's another challenge that we can think about. I don't know. We could speak also about the tough legacy contract solution that are being offered by the regulators, but maybe Naveen, you want to keep that for later and look at some other challenges that the industry is facing.
Yes, that's fine. We can cover that afterwards.
Thanks, Virginia. John, I think maybe that is a good segue to the next part to talk about the impact on the valuation and methodology, in particular on the credit-sensitive benchmark. Maybe Ross, is there something you could share with the audience?
Sure, John. Thanks. So look, I think when considering valuations, I think the first thing to think about is how it really fits into the process of the transition. And I think, the first step that I think about is certainly the banks and how they're assessing their risk and their positions with their counterparts, and they need to obviously understand their valuation situation. So there's a lot of work going on with the banks to assess the valuation side, and I'll come on to some of the details in a second. The second piece is obviously once the banks have understood that exposure, they're then going to, as Virginia mentioned, outreach to their counterparties and really start to engage them on the documentation and redocumentation and repapering of those agreements. And the first question, if I'm sitting on the other side of that conversation as a client of one of those banks, is what's the impact of that change, that contractual change, to the valuation of my asset, be it a loan, a bond, a derivative, or so on. And obviously the ISDA protocol is going to help with some of that unclear derivative side in terms of the repapering process, but it still doesn't step away from the fact that there is a difference in the valuations between what you had previously in a LIBOR environment versus what you're going to have in a risk-free rate environment. And then I guess that brings me to the third step, which is really the clients assessing their exposure. Now, certainly my opinion is banks aren't going to be out there giving advice of what to do to their clients in terms of how to migrate or what to migrate to. So there's going to be a responsibility of that client or that buy-side participant to assess their own valuations and understand the implications of those contractual changes. So when we think about, what does the valuation impact mean, I think first and foremost, you've got to kind of consider the differences between LIBOR and the risk-free rate. So firstly, LIBOR is a term-based reference rate and has a credit component embedded in it. The risk-free rates don't have that same credit component by kind of definition. And also in many cases where people are using the overnight risk-free rate, such as SONIA or SOFR, it obviously doesn't have that same term element to it. So you've got some kind of fundamental differences between the rate that you're using today and the rate that you're going to be using in the future, and that's going to have an impact on the valuation and fundamentally driven by that credit component. I think also a really important point to mention is the difference between the LIBOR and the risk-free rate isn't a one-off static difference. It's a dynamic basis that changes over time. So if you observe the market stress that we've gone through in 2020, you've seen the spread, for example, in SONIA between the risk-free rate and LIBOR as wide as 80 basis points down to kind of 10 and below. So timing of the movements from your LIBOR contract to your risk-free rate-based contract is also something that's important to consider for the buy-side participants. So all of these things, in my mind, mean that, firstly, the bank has to assess their valuation impact, but secondly, the counterparty or the client side also needs to be doing a lot of work to look at the impact and also look at the different scenarios that they need to take into consideration, whether they're relying upon fallbacks or whether they're looking to replace their existing contracts and I guess migrate those contracts in the meantime prior to the cessation. So I think there's a number of things to consider, but certainly the dynamic spread between LIBOR and the risk-free rate is a key component in the valuation question, and something that needs to be considered because obviously that is dynamic and will continue to change over time, so it needs to be assessed on an ongoing basis. And again, as Virginia mentioned, from a counterparty perspective, if you've entered into a loan transaction and a derivatives transaction and you're currently fully hedged, as you migrate, you're going to need to make sure that you're migrating in such a way that continues to offer that same hedge and you don't open yourself up to additional basis risk, or work with your bank counterparty to understand that basis risk, and ultimately someone's going to have to take that exposure. So that's certainly something to manage. So those are a few of the things I think worth considering on the valuation side.
Thanks, Ross. Tri, anything to supplement?
And maybe I add a few more points, from the technology side as well, because I mean, I think what we heard from Ross and from Virginia as well, but to reiterate that, the LIBOR, like Ross says, is the forward-looking term rate known in advance, right? So the cash flows and all that are easier to identify. Whereas, this risk-free rate, overnight, daily rate reset in arrear, so need to be compounded or averaged over the cash flow periods. And that's why these new products linked to the risk-free rate also have other convention, things like, look back and log out and observation shift and all those new feature, new convention that we, all the market participant, and also you need to adapt their IT system to support that, right? So the challenge is all in the detail where, you got a lot of transaction, got a mix of different feature, and right now the market is still, evolving where, there's still somewhat no clear consensus across, different product type to a set of feature, right? And those impact the valuation as well, and then at the same time, flowing into the risk, the P&L, the hedge accounting that Rod and Virginia mentioned as well. And then, on the other side around the spread that Ross mentioned and Virginia and John mentioned about the fallback as well. For the ISDA, fallback it be a lot clearer, at least, a bit, people can follow. But for certain other product, especially like cash that Virginia mentioned as well, the spread for those fallback is still, being, need to be negotiated somewhat between bilateral counterparty, and that, generate a lot of challenge as well. And probably, finally, I would say that, again, the market's still moving. So, if you look at like vanilla product or vanilla derivative, at least, there are certain, convention there that people can follow, but it's a more complex product, like optionalities and so on, is still in the early stage of development, both in terms of pricing, in terms of market data, in terms of liquidity. So, you can see that the market is still evolving. We have a lot of challenges there in terms of the product and valuation, but we will need to keep adapting and keep evolving to keep up with the market as well.
Thank you very much, Tri. So the next question is for Virginie.
I think the next item we wanted to touch upon was what the regulators are expecting in this process. And John already mentioned a few milestones that has been pushed back because of the sanitary situation. But there are some quite key or strict milestones that the regulators are giving us in terms of when do we have to transition. And this is also part of the challenge, because I think the industry is finding those milestones a bit challenging. We have the example of the US, which has been followed by the HKMA, where they ask the industry to stop issuing loans referencing LIBOR after June 2021. A bit more aggressively, as mentioned by John, the UK, and which may be followed by the Singapore regulator, is setting this milestone to March 2021. Also, what the regulators expect is that adequate fallbacks in loans or in derivatives will be inserted already at the start of January 2021. So on the derivative side, they know that the industry is dependent on the protocol timeline, but on the cash side, they will expect to see some robust fallbacks in 2021, at the start of 2021. And if we take the example of the LMA template, for example, for a long time, the industry was using a template amendment agreement, which was giving the possibility to parties to amend at a later stage the agreement. What the regulator is saying is that it is not sufficient. We want to see a hardwired fallback where you indicate on what you're going to fall back once LIBOR ceases. So the timeline is very short. We're already at the end of 2020. And in terms of regulatory requirements, another thing that the industry needs to keep an eye on is what will happen with margining, clearing, trade reporting obligation when we amend our contract. So we know already that some regulators have given some relief, but it's not something we've seen in every jurisdiction where we have those type of requirements. The relief might not be fully consistent across the jurisdiction. So it is also something that the industry will have to monitor very, very, very closely. And finally, the last item I want to mention quickly, I quickly mention it at first, is the TAF legacy contract solution. Those are solutions that the regulators are trying to offer. We've seen that in the US, we see that in the UK as well. We also have a proposition in the EU. It's basically solution that the regulators are offering so that we can transition by way of law the TAF legacy contract, which are the contracts that we will not be able to negotiate or to amend. So we're thinking of certain type of securities, for example. So this is on the table. It triggers a lot of questions. Regulators are looking at it. Legislators are looking at it. The industry is lobbying because it triggers many questions in terms of what contract is it going to apply to? Is it enforceable everywhere? And what will happen in countries like in APAC, where we don't have such legislative solutions?
Thanks, Virginia.
Yes.
Just to add on to what Virginia mentioned, the expectation of regulators is, especially for regulated firms, is no longer just knowing about what LIBOR is. The collectively regulators are expecting an active transition beyond just planning now to taking action. A couple of things, the key takeaways regulator would expect is they expect regulated firms to now familiarize themselves with the requirements on how do we plan from knowing your actual exposure, identifying your counterparties, and also understanding the benefits of moving away from LIBOR or IBOR and removing the exposure on your bank credit risk, and consider suitability of active conversion from legacy products to build in fallbacks, and also identify where appropriate replacement fallbacks that have been recommended or suggested by the relevant bodies like ARC, the sterling risk-free rate, and in Asia Pacific, the relevant equivalent of the trade associations or banking associations or bodies, where they make certain suitable recommendation or what the alternative risk-free rate will be. And one of the things that the regulators are key now is about client engagement, outreach, client education, because this is not just a repapering exercise. At the end of the day, it does have what we call a value transfer, and it is important to engage the counterparties. It's important to engage clients so that parties can work out a solution with respect to the LIBOR transition. And I think that is key. As we progress towards next year, the efforts moving from active transition will accelerate. I think with that, maybe I'll ask Troy to share where he sees from a technologies perspective, whether people are now adopting any changes with respect to the active LIBOR transition efforts. Troy, if you could sort of share your perspective.
Sure, John. Yeah. So, as you mentioned there, right, the regulator now also expect all the firm to be actively moving, transition to the new risk-free rate. And you can see that in the past, most of the firm had been focusing on, make some changes to understand the exposure, understand what the LIBOR, identify those exposure to LIBOR, and also start to support, this new feature that we mentioned earlier, right? The look back, the lockout, and so on and so forth. But now what I see is that, a lot of firms now start looking at actively moving away from LIBOR and support both the migration that Ross mentioned earlier, but also supporting the fallback, right? So a lot of discussion, a lot of active, conversation with all the, technology provider like ourselves as well. Having said that, what I also see is the bigger firm, the bigger bank tend to be more advanced in some of this preparation, whereas the buy side or smaller firm are still a little bit behind, right? Having said that, like we said earlier, it's still evolving market where they need to do some now, but the market's still changing. Having said that, we see that a lot of work in the next 12, 14 months, whatever the time frame may be, to get ready, and IT system should be the forefront of that transition as well.
Yes, understood. So I will go over to Ross
Virginia,
and
do you
John.
want to talk about the cleared and uncleared and the non-linear derivatives? I know you earlier talked about the TAF legacy contract, and I think it's important maybe to share with the audience in terms of where we see the sort of industry moving in terms of the treatment between vanilla derivatives and the non-vanilla derivatives, non-linear derivatives.
Yeah, so you mentioned the cleared and non-cleared derivatives. I think that when we talked about repapering and we talked about the ISDA solution, but for cleared derivatives, obviously this will be dependent on the rules of the CCPs. So there is also a question of timing here when the CCPs are going to change their rules, because that's how repapering is going to happen for cleared derivatives. I think for non-linear derivatives, so I'm not an expert on the business side. I'm on the legal side, but the difficulty we'll have is what we mentioned earlier, is that some agreements, are not appropriate to fall back under the current agreed fallbacks, which are inserted in the fallback supplement to the 2006 definition. And so that means that banks and their clients will have to discuss what they want to do with the existing contract, how they wanted to transition it, and that will involve discussions, bilateral negotiation, and bilateral repapering. In some situations, you may have to carve out your contract from the protocol, because once you have adhered to the protocol, all your transactions are automatically transitioned under the new definitions. For contracts that should not, because they are non-linear, it's not considered as appropriate. There should be a carve out from the protocol, which will involve bilateral amendments.
Thanks, Virginia. Maybe that's a good segue also to look at the buy side as well. Ross, I think earlier you mentioned about the credit spread, the credit component and the difference between the risk-free rate and LIBOR, which is a term rate with a credit component. If the audience is obviously coming from the buy side, how do they grapple with this? Because what sort of key considerations do they need to think about as they transition from IBOR or LIBOR to the new risk-free rate?
Sure, thanks, John. So look, I guess my message to buy side participants first and foremost would be to be proactive in this process and to be very aware of what's going to change. As I mentioned earlier, and has been mentioned by many of the panelists, we're now getting to the stage where banks are starting to outreach to their counterparties, looking at the ISDA protocol to migrate non-cleared derivative transactions using the protocol. And fundamentally, I'm of the view that a buy-side participant can't adhere to those protocols until they understand the financial economic impact of making that change, which is kind of the valuation point that I made earlier. So being proactive and understanding, firstly, what the changes are, and secondly, assessing the economic impact, but not just doing it at a point in time as of what's the impact today, but because the spread between LIBOR and the risk-free rate is dynamic, that economic impact will be different over time. So, to look at that, I think, buy side need to be proactive. I think you're going to see outreach from your bank participants, if not already, very soon. They will be coming out to look to kind of repaper existing agreements, and really the ability to assess those different scenarios, i.e., are you going to rely upon the ISDA protocol? Are you going to rely upon fallbacks? Are you going to look to opt out of certain transactions with your counterparty because they're economically not viable under the fallback regime? Those are considerations and preparations you can be doing now to make yourself set up and aware of what those changes are going to be. And again, just to reiterate a point I made earlier, my clear view is the bank are not going to give you advice. They're going to come and offer you options. You need to be proactive to be informed about which is the best option for you and be in a position to obviously elect to pursue that option. So that would be my kind of key message, that proactivity and really understanding the implications across, your loan portfolio, your derivative portfolio, and so on. So those would be the key points I would make, John.
Thanks, Ross. Just for the audience benefit, Naveen has some audio issues, and that's why we sort of want to make sure that we move the discussion and topics that we have structured along as well. Thanks for your indulgence. So I think the key questions, thanks, Ross, for your explanation. I think one of the things we would like maybe the audience to know is, maybe for you, Tri, is what tips or guidance would you provide to sort of the audience here in order to plan for the end of 2021 as we approach the timeline for the LIBOR phase-out or IBOR transition?
So I would think that, like what Rod mentioned earlier as well for buy side, but probably apply to everyone, just to get ready early, right? Because the time fly, quick. So, break down the project or the process or the program into a smaller chunk, so that get ready early. At the same time, having the conversation with your counterparty, either your buy side, your sell side client, and so on, but also your, service provider, the technology providers, other market data providers, and so on, to understand, what you need, what they are doing, and incorporate that into the program. So probably the key thing there is, get ready early, talk to, the different people or different counterparty that you interact with, and then from there, it's going to impact your program.
Thanks, Tri. I think we have obviously a couple of minutes for key takeaways. I'll just go around to everyone. Maybe starting with Virginia. For the audience, what are sort of key take-home or key takeaways that you would like to send or speak about?
Yeah, I think it's similar to the other panelists. And Ross mentioned that the banks will not provide advice. I would say that the banks will not want to be imposing anything to their clients. I think it's a matter of conduct that the banks are being very careful about the way they will process the transition. It's something that the regulators have insisted on as well. And so, yeah, I would recommend. I mean, when we look at everything we talked about today, there is a lot to do in a very short time. So I would definitely recommend that everyone gets, ready as soon as possible, aware of the portfolio, aware of the risk, aware of the steps to be taken, and start talking to their counterparts as soon as possible.
Thanks, Virginia. Ross, could we have your views too on key takeaways?
Sure. I'd reiterate the proactive and being prepared point. I would say, in terms of the engagement with your counterparties, that's going to be critical over the coming months, but also the preparedness on your own side as a buy-side participant to understand the economic impact of the change. So you can kind of split your focus. What the ISDA protocol type structure allows is for you to have an umbrella migration of certain transactions. But what you want to do is focus on the ones where there's a material economic difference, and then spend your time in engaging with your counterparties. You can't do that unless you understand your economic impact. So that I would say would be the first step. Look at the different scenarios, look at the economic impact, and then you can go into those kind of contractual type discussions, well informed and aware of what you want to do next, and make sure that you're obviously well ahead of the end of December next year to make sure that those changes are made.
Thank you, Ross. Try any key take-home messages?
Yeah, I reiterate what we said earlier, but also specifically from the technology side, we need to get ready early. Also because you would want the technology or the system to be able to support the business way before the business may need that. That's why you need to get even earlier. Also, sometimes you need to double check with your technology provider. Do they have enhancement or any changes for the system? Do they need you to do any upgrade or do any changes specifically to the version of the system you need? Because sometimes that may delay as well. So again, get ready, talk to your counterparty and your system provider to do that. So maybe John, maybe you can share your takeaway as well.
Yep. I think we've heard from the fellow panelists the key takeaway, but just a couple of 1 minute for me is that this is here to stay, and as you note, the buy side and the sell side needs to work together in terms of trying to move IBOR or LIBOR reference products into the new risk-free rates to the extent that the risk-free rate exists. And I do think that as we approach towards the end of the year and next year, our principal regulators and for those that are in the regulated financial firms, this will be a key focus of the regulators, because they're keen to make sure that the time to take action is now, and we only have less than 13 or 14 months away before the end of 2021. So I think this is key, and this is a very important initiative and milestones that globally regulators are very focused on. And I think on behalf of myself, I'd like to thank my fellow panelists for sharing their insights with all of us, and to the audience as well for being very patient with us to sort of listen into the topics. And I'd like to thank Asia Risk for organizing this session, and Naveen as well for moderating. Thank you all, and have a good week. Thank you.
Thank you very much.